Today we are going to take a look at the number one investment strategy for a recession. Hello and welcome. My name is Peter B and I welcome you here at My First Million, where we are achieving our financial goals together. So, in my last video about investing, I covered the second best investment strategy during a recession. So check that out as well too. But now back to today's video's topic. What is the best investment strategy during a recession? Most certainly for beginners, but very often potentially also for even investment professionals. The number one best strategy is potentially dollar cost averaging. So for this, let me switch to my whiteboard. What does dollar cost averaging means? So dollar cost averaging is basically the practice of systematically investing equal amounts of money at regular intervals, regardless of the price. So let's dissect this. So one part of this definition is systematically. So I think that's especially one point that happens in a recession is if you don't follow a system, then you potentially start to react emotionally, especially when you start to see more and more losses in your investment portfolio. So with the dollar cost averaging method, you should be able to avoid any irrational decision or any emotional decision during a recession, especially when you see your investment portfolio is going down. Then another thing is equal amounts. So in a specific interval, you always invest the same amount. And again, just what I mentioned before, you have regular intervals. So this could be weekly, this could be monthly, quarterly, or even annually. But you have regular intervals where you always invest the same amount of money. And the beauty of this investment approach is it is very unemotional. Again, it takes out all the emotions and irrationalities of any investment decisions that you would be taking, especially in a recession when you see losses in your account. It might feel like, oh, you're losing money during a period of time. So how does dollar cost averaging works? So you can see here, this is just a raw drawing. A market, an investment market, usually go through cycles. It goes up and down and up and down and up and down. Best you can see this in the stock market, where you can see all kinds of charts from daily charts to annual charts and so on, where you can see all the fluctuation in the markets, where it's going up or down. Then, however, you see the blue line here. This is the general tendency of the market. In the very long run, so if you have a long time horizon, the stock market, for instance, or also other markets are going in general up. So for the stock market, for instance, what you will regularly hear, you should be able to get a return of maybe 7 to 10% out of the stock market, depending what resource you're taking a look at for as a reference. But you see here, this 7 to 10% is just the average over a very long time horizon. Sometimes it's going up and you will have much higher returns. Sometimes it's going down and you will be going into the minus. So a common mistake what people are doing is they get emotional during these investment cycles. So when they see the stock market is rising and it's booming, then they feel like they get a fear of missing out feeling, and they start to invest at maybe potentially the peak. And then once everything is collapsing, they get very afraid, and then maybe because they are afraid that they might be losing everything, they will start to take out the money from the stock market into cash. So as a result, often what you see, if someone is investing emotionally, they will buy high and then sell low. And of course, this is just what we don't want to see happening. So with the dollar cost averaging method, as mentioned, you will invest the same amount at every time interval. Let's say, for instance, all those red lines here are points in time where you were able to invest $1,000, for instance. So you invest here once, then here once, then here once, and again all the way on the downward cycle. And you continuously do this throughout your investing career. So what happens then? Sometimes you pay too much, more than what maybe the potential valuation, the fair value should be like. But sometimes you get a bargain and you pay much less than what the potentially fair value should be like. So as a result, this will even out over time. And you should be able to get the returns from the blue line. And you see here, if you have a very long time horizon, maybe at the beginning of the first peak cycle, at the peak here of the first cycle, you think you did an investment into very expensive peak, but if you have a very long time horizon, you see here at latest on the third cycle, the peak is already average. And if the cycle continues and you have an even longer time horizon, maybe the peak here nowadays would be maybe even the bottom in the market in the future. So this also is the power of having a very long time horizon, which plays effect. So if you use this strategy and have a very long time horizons ahead of you. So now let's take a look at the real market data here. This is the performance of the S&P 500. The S&P 500 basically covers the 500 biggest companies in the US that are traded on the stock market. And you see here again, not as clearly as in the chart before, but you see here the stock market is going through cycles. Even on the time very much back to the beginning of this chart, you see here, although it's not very obvious because this is a linear chart, there were already some very significant drops here on the way. Then you see here early 2000s, this was the dot-com bubble. Then 2007, 2008, this was the Great Recession where the real estate market collapsed. And then since then, it was pretty much on a steady uphill. And this sharp decline here that you can see here, if you see my cursor on your monitor, this was the COVID outbreak and now the recent decline. So everything on this chart will give you some perspective on how things could be doing. For instance, you could be investing at the peak of the dot-com cycle, and by the before the financial crisis, you would have more or less your money back in. But then it dropped again, and then around 2013 at latest, it never went as low as the peak, at least the S&P 500, never went as low as the highs of the dot-com bubble. So every investment after 2013 would be potentially more expensive than at the peak at the dot-com bubble, at least for the S&P 500 again. So sometimes you might be investing at the high, but over the long period of time, this will still look like a bargain. And sometimes you invest with the dollar cost averaging method at the bottom, and this will be the most beautiful, of course, kind of situations that happening here. So this also shows why the dollar cost averaging is so attractive, because basically when the market is dropping, you are able to buy the same kind of shares that you would buy anyways at a discount. So it's like Black Friday sales or Christmas sales again. So again, dollar cost averaging makes use of discounts in the markets, but without timing the market. Let's take a look at an example here. For instance, you want to invest 1,000 US dollar at a regular interval. So at the first time when you place your first investment, maybe the price of the shares that you want to buy. This could be, for instance, a specific stock, could be a mutual fund, or what I would usually recommend, especially for beginners, to take a look at ETFs. So maybe let's say this is an ETF. The price of the ETF is $100. So if you invest $1,000 divided $100, you can buy 10 shares of these ETFs. So now the price maybe is going up to 125. So at the beginning of, at the next interval, when you are putting the next $1,000 into the market, you need to pay $125. So with this, at this price, you are only able to buy 8 shares. Then maybe the price is dropping to $50. Maybe there is a recession, or there's a stock market collapse, or something happened to it. So the price will fall down to 50. And at the next time when you invest, you only need to pay $50. So you can at that point buy 20 shares. So the feeling is like you're getting a bargain now from your investment, from the 1,000 that you're putting into the market. Of course, you could say, why don't invest every 3,000 at 50? Of course, this you could argue about, but most people aren't able to properly time the markets. Even like someone like Warren Buffett is not able to time the market properly all the time. So, but with the dollar cost averaging method, you are able to also take advantage of these discounts. You see, at the end, you bought, with $3,000, you bought 38 shares, and the average price of the 38 shares you paid for is around $79. So cheaper than the first investment and the second investment, because you were able to take advantage of the price decline. So taking a look at the second example shows us how awesome it really is when the markets are dropping, if you have a long time horizon for investing, and if you do follow the dollar cost averaging method. So let's say you start out, let's say the fair value of this current stock market is somewhere between 50 and 100, but we don't know exactly where. And let's say current price is $100. So if at the first time we start investing, we pay $100 per share. So for $1,000, we get 10 shares. Then at the second time, the market is dropping to the lower area of this band, to $50 per share. So at this point, we can invest $1,000 again, but we will get 20 shares from it. So as a result, we bought 30 shares in total, but on average, we only paid around $67. So less than what you would be happening if you would both times just buy 10 shares. If you buy 10 shares first and buy in the second time also 10 shares, it would be $75. So the lower the price gets, the more attractive or the more helpful it will be for a long-term time horizon performance of dollar cost averaging. So I use dollar cost averaging for my ETF saving plans. So every month I put a specific amount into specific free ETFs, and over time I just average those out. So my plan is to do this continuously until I retire. So this is how I'm using and taking advantage of the dollar cost averaging method. And especially I felt like now, like in the recent downturn of the market, this is a very relieving method of investing, because every time I put money in, I feel like I get more shares for my money than what it used to be. So therefore I can take advantage of the down cycle. Do you have already some experiences also with dollar cost averaging investing method? Or do you have any experiences, good or bad, in trying to time the market? Please share in the comments below. And I hope we can learn from one another here in our community. Thanks a lot for joining me today. I look forward to see you in my next video, and especially I look forward to see you winning financially.